has continued to decline for the fifth consecutive month. The annual headline inflation rate peaked in October 2011 and has since dropped by 9.3 percentage points, demonstrating that the Bank of Uganda's monetary policy stance is working. Annual headline and core inflation declined to 21.2 and 23.6% respectively in March 2012 from 25.7% and 26.7% in February 2012. However, annual non-food inflation remained high at 23.8% in March 2012, having only fallen by 0.5% during the month, and hence it is a concern for monetary policy. The latest macroeconomic indicators point to a rather gloomy and uncertain outlook. GDP growth in the first half of 2011-2012 decelerated. Credit growth has stagnated, although monetary aggregates have begun to pick up. The exchange rate came under strong pressure in March, depreciating by 6.8% against the US dollar, which was a larger depreciation than the depreciation of currencies of our partners in East Africa. The weaknesses in the global economy are adversely affecting Uganda's exports. Global commodity prices, especially oil, rose during March, and this threatens to increase pressure on domestic inflation. In addition, domestic food crop prices rose in both February and March because of drought, and may increase further in April. The Bank of Uganda still aims to reduce annual inflation to single digits by the end of this calendar year and to around 5% by mid-2013. And the bank will set its monetary policy to achieve this objective. Although inflation is on a downward trend, the risks to the inflation objective have risen, in particular because of the developments in the oil price, the exchange rate, and the food crop prices that I have just mentioned. Because of these risks, the Bank of Uganda will pause its easing of monetary policy and hold the CBR at 21% in April. The band on the CBR remains at plus or minus 3 percentage points, and the margin on the rediscount rate remains at 4 percentage points on the CBR. The rediscount rate and the bank rate, therefore, will remain at 25 and 26% respectively. Once we see the risks to the inflation outlook receding, we will resume easing monetary policy. This is the end of the policy statement for